So, hello, and a massive hello to everybody. Hope everybody's having a great day wherever you are, whatever you may be doing. 50 pips, rocking and rolling here. No trade calls or recommendations. They're responsible own stuff. We're here for educational purposes only. So, what's going on, guys? Hope everybody's having a great day. Here we're going on with another one of these Substack videos, and let's look at SPX, a technical look, unbiased. Let's see what happens. So, where are we? Where are we? What's going on? So, here we're kind of stuck in this broader zone, right? With a little bit of a pullback, a little bit of heavy selling, but globally still pretty much an all-time highs. Now, to frame this in terms of bigger picture, you can step back on something like a weekly, right? And what we had been looking at, if you fib this low, right, the low we had here, all the way into the 2020 high here, 22 high. We came back into the 50 back, and then we're moved up in extensions. And what we were talking about last year, for those of you who remember, towards the back end of the year, we expected this 150 extension, the 6100 to hold, right, in what is essentially a pure symmetrical move, right? Enough to get all the harmonic guys and the Elliott wave guys excited, right? Now here, as we're hovering, this is a classical place where you would expect either, crazy blow off kind of action or, some kind of a stall. So all things being equal, technically, this is an interesting place for us to stall and to take a little bit of a pause. Now, going back on the daily, what we've been discussing also on Twitter is the pivotal nature of the 6,000, right? And the fact that on the break below, we were expecting the 200 DMA to attract. And this was the case for a lot of things, whether it was Tesla, whether it was that Mag 7 chart, et cetera, et cetera. So, and as we said, when we're coming into this, this is where, if it's going to bounce, this is where it's going to bounce from. So how to look at it now? Well, here you're in a little bit of a thorny situation or a tricky situation, because anybody who is short off the highs and is looking for a hardcore break, the system's broken, Trump's going to mess everything up, whatever, right? There is no way they're really going to change their mind unless we print new highs, right? That even if we come all the way back into the highs, they're going to say, okay, it doesn't matter here. We're putting in some kind of a complex head and shoulders, yada, yada, yada. So you're in a situation where those bears are kind of almost home free. If they've got a lot of wiggle room, we can rally a lot, and it's not really going to change their mind. Now, the interesting thing is on the long side, everybody who is looking to get back long, right, despite the fact, as we've been discussing, this has been hedge funds deleveraging, selling into retail YOLOs trying to buy this. All these guys, everybody pointing to the fact that the low is in, low for the year's in, sky's the limit, we're going to go back to 7,000, whatever. They're not going to give up unless we get closes below here, right? So the way we like to look at this is to use two main instruments, right? One is that 200 DMA, and two is a shorter term moving average, is the 10-day moving average. It's a very good, very useful moving average to look at in terms of short-term Momo and flow switches. Now, granted, this is a huge chop zone now, because as I said earlier, the stubborn bears are not going to give up unless we take out those highs. The short-term bulls aren't going to be giving up unless we take out those lows. But the way I would look at it a bit more of a granular level is that essentially here, this is a neutral phase or chop zone, right? So you can call it neutral, you can call it chop, whatever you want. And what that means that is you shouldn't be confused by velocity of move inside range. Now, remember, the most brutal rips, rallies come in bear markets. So just be careful here. Velocity of move doesn't really change much, right? So the way we be looking at this is this is a huge tradable zone intraday where you can get very aggressive. You can make money to the long side, short side. You can lose money to the long side or the short side, but it's a two-sided trade in here. Now, should we ever get a day close, week close back above the 6,000, right? Despite what the broader picture, the convinced bears are going to think, chances are very high that those highs get tested, right? You could get a huge squeeze, and then you would really expect us to, if we fail, we'd have to fail from the 6,100. A day closes above that, you'd expect this to really accelerate to the long side. You'd have to be, very, very bullish, right? And on a day close below these recent lows we just put, then you have to think that this gets very bearish. Any bounce back into that is going to be resistance, and there's a clear chance that we unwind, all the way back down into these lows, back into the 5,000 level, right? I think if you're somebody who likes round numbers, the ones I would look at is I would forget the 200 DMA and look at it this way. 5,700 is the bull bear line here. 6,000 is the bull bear resistance, and 5,000 is the bull bear support. So even here, I think there's on an aggressive move, there's a lot more room to move freely to the downside than the upside, right? So I think you have to be cautious. Now, if you flip it back to a monthly or a weekly, on a big break, there's a lot of room to come down right into the 50-month, into this previous high. You can look at it in the weekly, that's the high. You got the 100 week coming in here. So that 5,000 is really into play. So that's what I would be looking at, and that's what I would be using at for levels. And also, I just like to say, I think here, when you've got to remember, you can't trade the market the same way when the VIX is in the mid 20s than when the VIX is in the low teens, right? And I think here, as we've been discussing this year, a lot of people are going to get chopped up trying to hold on to position trades that they really want to get going, right? And hold that for a multi-month period. And I think that's not the ideal strategy for the year. I think what we're likely going to get is a tape that's very nervous, a lot of headline risk, a lot of flip-flopping from Washington. And I think it makes sense to continue to trade tactically with minimal overnight risk and press it intraday on those levels. But again, that's the way I'd be looking at SPX. I'd be focusing all those levels, 6,000, 5,700, and 5,000 to the downside. Anything inside this 10-day and 200-day is very, very messy, is very neutral. And even though here it's trying to bounce, if you look at what's going on under the surface, you'd expect these lows to have to be tested again. And also remember that because of the nature of the weighting of the indices, even if you see a lot of money pouring back into, rebound, rotation back into maybe, infrastructure, construction, defense, stuff like that, you could still get a situation where the indices are still flat to down, but a lot of names rip aggressively. So I think if you're looking at those kind of plays, it makes a lot more sense to look at single stock names than necessarily the indices. But that's where we are. Okay, wishing everybody an awesome day ahead. Wishing you all the best. Take care. Talk to you guys soon. Bye bye.